You are listening to The Investor Way with Sam Ball and Jonathan McEwen. If you enjoy the show, please subscribe and follow us on Twitter at TIW
Hello and welcome to The Investor Way with myself, John McEwen, and my co-host Sam Ball. This week on The Investor Way, we have Marks and Spencer's, Greggs, Tesco's, Agronomics, Sainsbury's, and our US company of the week is Etsy. Sam, shall I kick us off with M&S?
Absolutely. Is the turnaround continuing?
Well, yes, it is the answer. So they had their Christmas trading statement out with Marks and Spencer reporting third quarter revenues of £3.9 billion, up 6.4% on a like-for-like basis and ignoring the impact of exchange rates. Food revenue was up 8.9% on a like-for-like basis to £2.6 billion, driven by a 6.6% uplift in volumes, making M&S the top-performing store-based grocer in terms of volume growth over the period. The remarkable value line also performed particularly well, with sales up 14%. In clothing, homeware, and beauty, like-for-like revenue rose 1.9% to £1.3 billion, and the group continued to gain market share. Renewed stores continued to outperform expectations, but in-store sales fell by 1.5%, in part due to the poor weather. Online sales grew at a double-digit rate and now account for over a third of the division's total. The group haven't given any full-year guidance, but markets are forecasting full-year revenue growth of around 5.5% to £13.8 billion, and the shares were down nearly 5.5% in early trading. In terms of valuation, M&S has a market cap of £6.7 billion and trades at 12.5 times forward earnings with a prospective dividend yield of 1.8%. I thought these results were very good. I'm not sure why there was such a sell-off in the shares, whether that's people taking profits or whether it was higher numbers baked in. I know we haven't covered it for a little while, but as far as I can see, the turnaround is going very well. I thought these were great figures, and we'll come on to some of the more standard grocers and talk about their numbers, which are much well, they're much more moderate than I'd say this statement from M&S. In terms of an investment currently, I think that they've done a good job in turning it around. However, I think Tesco's is certainly more defensive and resilient, I think, and has got much larger market share. I think probably a higher quality business. And whilst things are going better in the clothing, home, and beauty, it's not fantastic. And I think there are just better businesses, whether it was Next or if you wanted a pure play grocer, probably Tesco's there. Shares aren't particularly expensive. I think you could do a lot worse, but it certainly isn't sort of high up there on either a watch list or picks in this sector for me. Sam, what are your thoughts on this trading statement from M&S?
The statement itself is excellent. I agree. There is nothing obvious in here where you would read that and think, well, shares were probably down after this came out. I don't know if it's the lack of guidance potentially, but if that's third quarter and it's going that well, it would have to have really dropped off in the fourth quarter. So it's really odd. And it's not hugely expensive either. So it's not like it was priced to perfection or anything. I think it's an excellent statement. I think in the last couple of years they've done fantastically well. And that is reflected in the share price. So it's actually up 137% in the last 2 years. So I actually like it. I think at a forward PE of 12 or 12.4, I think that's pretty reasonable. I think you can make a decent argument for it. The only issue is it's the same issue we used to have when we would cover Morrison's before that got bought out by PE, where we always liked Morrison's and it was fairly reasonably valued, but you would get to the point you've made of, well, wouldn't you just buy Tesco instead? I don't know. The only thing is with Marks and Spencers. So this is getting very anecdotal now. But my brother shops at Marks and Spencers because they put less preservatives and stuff like that in the food. and they tend to use more natural ingredients. And he bought me a book on, well, basically on kind of the rubbish that's in a lot of the food you eat. And that's kind of converted me a bit. And then I went to M&S with him over Christmas because we needed to get something. And I actually thought the experience was fantastic. Like it just felt a lot like nicer than a Tesco or an Asda. And I know you do have to pay for it, but that's probably converted me. And that is just anecdotal, but I do wonder if there would be more of a trend of people want to, for example, I know it's not entirely related, but like for example, like the Bovir in the
Yeah.
milk, where there's a lot of people who don't want that. I don't know if there's more of a trend of people not wanting kind of these additives or whatever else in their food. M&S is a viable option because their food generally just has less preservatives and like pesticides and whatever else in it. So I don't know about it. I think at 12 times earnings, I actually think it's pretty reasonable, given that I think this turnaround has been going on long enough that it seems to be an actual trend rather than just a couple of good quarters and then going back to how it was. I think they have actually started to turn this business around, and I think there's quite a lot to be optimistic about. But I might still choose Tesco instead if I had to own one.
Yeah, and I suppose at that end of the market that you're describing, there is also Waitrose. So I suppose that is, to some degree
Mm.
that's who you are competing with. I appreciate M&S perhaps has more of an emphasis on sort of some, posh ready meals, that kind of thing, as opposed to being a full-blown supermarket. But yeah, no, I take your point.
But I think as well that the dividend yields quite a bit off Tesco's, and if the turnaround continues, hopefully that will come back
Yeah,
up. But you primarily buy in these businesses for income. The only other positive, and it's only a positive now, it definitely wasn't at the time, but I think the investment in of the 50% of the Ocado retail business has been a disaster. I don't know if there's any sign that will ever contribute positively, but I think the good news is that the valuation's so cheap that it's not priced in at all,
yeah,
which is good because I don't think it will do anything.
yeah.
But you know what I mean? It's not like it's at 18, 20 times earnings and you're thinking, well, for this to actually justify the price, Ocado really has to
Yeah,
perform.
no, absolutely. Absolutely. Fine. Shall we move on to a fairly highly rated business, Greg's?
Yes, so it's one we've covered multiple times. The pasty maker, they have come out with a fourth quarter trading update and they have announced 11.3% revenue growth for the full year to a record 2 billion, with like-for-like sales growth of 5.5% compared to 6.3% expected. Total sales growth was slower in the fourth quarter at 7.7%, with like-for-like growth of 2.5% compared to 5.4% expected. Management called out lower consumer confidence and the resulting drop in high street footfall as a key challenge over the second half of 2024. Across the year, there were 145 net new shop openings, in line with targets, and 2,618 shops trading as of 28 December 2024. Greggs is targeting 140 to 150 net new openings in 2025. Year-end net cash was down from 195 to 125 million. And despite weaker sales, they've made no change to the full year 2024 profit guidance. And the current consensus is for just under 12% growth in pre-tax profit to 188 million. The shares fell 10% following the announcement of the trading statement. Worth covering as well, we've covered it before when we've covered this business, but they are targeting 3,000 stores. They're now at 2,618. They want a lot of these new stores to be in travel locations like train stations and airports, so they've got less exposure to the high street and footfall. And just under half of the shops are now serving until 7 p.m. In terms of the valuation, they trade at a forward P of 18.1, and that compares to a 10-year average of 18.3. The prospective yield for the next 12 months is 2.8%, and that compares to a 10-year average of 2.5%. I thought this trading statement was very good. I know the like-for-like growth was a few percent lower than expected, but equally they have maintained their profit guidance for the full year. So they've done what they thought they were going to do. In terms of the business performance, I think it's very good. I think the issue is that this has been quite an expensive stock in the recent past, and because of that, any kind of wobble and it is just disproportionately hit. it's now coming down to a more reasonable level of 18 times earnings, but I still think it's a bit pricey for me. I think I'd probably maybe want it at more 14, 15, because I think although there are avenues still to go down for growth. We've discussed it before, but particularly in the north, it feels quite saturated. So I think getting to that 3,000 stores is not a given. Well, it probably is. I think they probably will hit it. But then where do they go next? And then in terms of some of the levers they've been pulling, where they've been opening stores later, we made the point at the time that can't go on forever. Eventually, you get to a point where a lot of the stores are already open late. And I know it's only just under half serving until 7 p.m., but some of them will be in locations where it's just totally unsuitable for them to be open late. So they're never going to be at 100%. And when you see the slight drop off in the growth figures, although they're still very good, it does suggest they're kind of hitting those levers that they've been pulling are now not really as there's less low hanging fruit, I think, basically. So I thought they're good results. I think the valuation's a bit pricey, but more reasonable than we've seen it last time we covered it. But yeah, I'd still have concerns paying 18 times earnings for this business, although it is a very good business. What about you, John?
Yeah, I mean, I think when we first started covering it a few years ago, I did really like it. I think I felt it was well off saturation point then, and certainly in the south of England, which they were expanding into. I think we're much closer to saturation point in terms of the number of Gregs around. The other thing that's worth mentioning is, and we covered it when we did the budget show, but you've got the increase in NI and you've got minimum wage going up significantly, more for the 18 to 21s, but overall it's going up too. And I think that will certainly hit Greg's. So I think it's got a few more headwinds than it had before. And again, we've discussed it at length on previous shows with Greg's, but it's not the sort of business that you could see going abroad or going to Europe. Really, it's much more of a British company, and you wouldn't think that they would expect to go there. And therefore, we're left with, well, we could maybe have a few more at stores in airports and train stations, but I don't think that's going forward really going to turn the dial. I think this trading statement is very good, though. All that being said, probably wouldn't be buying shares at the current price.
All right, should we move on to our next retailer of the week
Yes,
then?
so it's the UK's biggest retailer. It's Tesco's, and it has around 30% of the UK grocery market. They had their Q3 statement out last week. And over the 19 weeks to the 4th of January, Tesco's retail sales rose by 3.1% on a like for like basis. And this was driven by growth in the UK and Europe, which more than offset a 1.3% decline at Booker, which is its wholesaler business. In the UK, the group managed to gain market share over the period, which helped volumes grow at a faster pace than the sector average. Full year guidance remains on track, with the group expecting underlying retail operating profits of around £1.9 billion. Retail free cash flow is also expected to land in line with the medium-term guidance of between 1.4 and 1.8 billion pounds. And the shares were down around 1.6% in early trading. In terms of valuation, Tesco's has a market cap of £24 billion and trades at 13 times forward earnings with a prospective dividend yield of 4%. I thought these numbers were pretty decent. They have strong comparatives, and we've seen Tesco's delivering, well, certainly over the last sort of 4 or 5 years now. Turnaround has essentially been completed. Little bit disappointed with the wholesaler decline with Booker, but it's got the very, very strong retail business in the UK. I think it's incredibly well run. It's incredibly efficient. It's got some of the lowest cost, well, probably the lowest cost in the business, and it's now able to compete with the Aldi's, Lidl's. It's invested a lot in keeping prices low. It's grown the market share, and it's doing very well overall. I suppose you might say, where does the growth end with Tesco's? And I appreciate it's still growing market share, albeit slowly. I think at the current valuation and with the current dividend yield, it probably is more of a dividend play. But I think good business overall. And if you're interested in an income stock, you could do a lot worse than it. I used to own Tesco's and owned it for quite a few years and maybe sold it getting on for sort of 18 months, 2 years ago. Sort of regret it because it has continued, but I think I was looking at more growth orientated investments. I think that's where Tesco probably isn't suited to, but overall, very, very good business. Sam, what are your thoughts on this trading statement and Tesco's overall?
I think it's okay. It's a bit lackluster, but the market leader, and as you've alluded to, there's not loads of obvious places where growth's going to come from. So it probably is just going to be steady as she goes. If it can outperform inflation by 1 or 2% every year, I think that would be a good result. My main issue now is because there's probably not that prospect of any significant growth in the share price, I don't think. I think if they do continue to grow market share, it will be very slowly and very slight. So then when you're looking at it with a prospective yield of 3.9%, although I don't think the valuation compared to similar stocks and retailers is unreasonable, the issue is if you're buying it and not expecting capital growth and you're getting a 3.9% yield, why wouldn't you just put your money in a bank account?
Well,
Because you can get
it's a
4%.
fair point, and I think talking about Tesco's and growth, well, obviously we've had the recovery, and it's been kind of back to basics, back to the grocery market in the UK, which probably around the sort of mid to later 2000s, there'd been the expansion, trying to make it in the States, trying to make it overseas, which they were badly burnt by, lost a lot of money. And I suppose that really ended the sort of real growth case for Tesco's. And you're now, as you say, just left with that core UK business. And if you're not expecting huge growth, now that the recovery is completed, what are you left with? Well, I suppose it is just an income stock. And as you say, cash or gilts, you can get the same level of income without any risk.
Not that I particularly buy income stocks anyway, but I'd probably want to see it at a sort of 5+% dividend yield,
Mm,
which I appreciate is in the current market for a business of this quality, you're just quite unlikely to get. But that's probably where I'd want to see it because you are buying it without an expectation of capital growth, or I would be.
yeah, yeah, no,
But that's not the business's fault.
no,
I think the results are
fair enough.
decent.
Okay, fine. Well, shall we move to the debut on the show?
Absolutely. So this is Agronomics. It's the first time we've covered it, so it is a listener request, but I thought it looked quite interesting. So for anyone who's not familiar, which was me until about 2 hours ago, Agronomics is a London listed company that's focused on opportunities within the field of cellular agriculture. So what that is basically lab grown meat. Now, this is a fund, so they're not doing the lab grown meat. They've just gone and invested companies that are. So on their website, they've got why invest. So if 80 billion animals are slaughtered every year for meat, 2 trillion fish are killed every year for human consumption, and 70% of the Amazon rainforest has been destroyed for animal agriculture. Moving on, just for a bit of background, but they've said agronomics is deeply embedded in the industry and has screened over 400 companies, investing in only the most promising startups. They say that of the 400 they screened, they've done deep due diligence on 75 companies, and then they've invested directly in 20 companies, well, just over 20 that are in the portfolio. They think their market has a $200 billion plus market size, which is probably not unreasonable if you basically just take the size of the entire meat market. They've highlighted that estimates from the United Nations suggest there will need to be a 60% increase in food production to feed the world's population by 2050. And Agronomics is currently the UK's only listed vehicle providing investors with exposure to a concentrated portfolio investing exclusively in this field. And in terms of what's in the portfolio, they've got over 20 investments within cellular agriculture covering beef, pork, chicken, egg proteins, dairy, palm oil, cocoa, cotton, leather, and a contract manufacturer for fermentation commercialization. So if we just pick a couple at random, one of the companies I've invested in is Blue Nalu, which is cultivated seafood, and that specializes in creating cell-based seafood products from fish cells. Let's pick another one. Meatable is a Dutch cultivated meat company focusing initially on pork and beef. They have an exclusive license on the OptiOx technology to develop food, allowing them to generate large amounts of muscle and fat tissue at lower costs than many competitors. Just one sec, I've just clicked for more information. And then if you click more information, it basically just takes you through to these companies' websites. So, for example, Meatable has got at the very front of the website. It isn't like meat, it is meat. So, in terms of the results, they've just come out with their audited results for the year ended 30 June 2024. And the highlights include a net operating loss of just under £11 million, and that compares to a profit of 22 million the year before, with no Shell Bay fee being due for the year. And there was a fee last year of 3.3 million. I've not looked in detail because we tend to do quite a brief overview the first time we cover it, and then if we like it, we'll come back and dig in a bit more. But I'm guessing Shell Bay is the management, some kind of management company that's basically taking a big chunk of the profits, and because there was a loss this year, that's why they've not taken anything, but or some kind of commission or something like that. But I've not looked into it. The board notes that the £10.9 million decline in the company's net asset value during the year relates primarily to unrealized foreign exchange losses, so that's fine. We're not too bothered about that. A write down in Geltor Incorporated of 7.3 million, and that was made in line with the new valuation set by the current round of investment. A write down in the position of Vitro Labs of 7.8 million. Cash balance reduced by 2.4 million relating to ongoing operating costs. They said this was counterbalanced by an unrealized gain on California Cultured of 2 million following a successful Series A raise, an unrealized gain recognized in Onago Bio of 3.8 million following the company's successful Series A raise, unrealized gain recognized on Clean Food Limited of 700k. It just kind of goes on like this. Operational highlights. There's quite a lot of them. Most of them tend to be talking about invested companies and how they've gone on to do another funding round at a higher valuation. One of them is portfolio company Meatly achieved a significant milestone in developing a protein-free culture medium costing only £1 per litre. And in the chairman's statement, Jim Mellon has said, since August 2023, 11 of the portfolio companies representing 51% of the net asset value have raised substantial funding rounds, collectively accounting for a substantial proportion of fundraising in the sector during the period. In terms of the valuation, there's not any earnings this year. The business trades at a market cap of just under £41 million, so it's pretty small. Let's see how the shares have done. The shares price is quite interesting, actually. So it trades at 4p a share. Year low is 3p75, and the year high is 11p.35. It's actually been as high, and I think this was in like COVID and stuff, but it's been as high as nearly 30p a share. But I think that was probably just kind of speculative hype. It's been listed since 2014 and is down significantly since listing. My thoughts are, from what we've just seen there, I find it very, very difficult to establish whether any of these companies have any competitive advantage. And the only way to find out would be to actually drill down into every company. But that would just be based on what's on the company's website, which if they're not actually publicly listed, they wouldn't be obliged to tell you a huge amount. So I don't even think if you were to go through the exercise, you would find out a huge deal. Even if you were to then assess whether the technology is, firstly, gives them any competitive advantage, but secondly, can be done at a cost level that it's economically viable, I think is incredibly difficult for someone like me to do. So I think if I were to buy it, it would just be pure speculation in terms of I don't have any idea what these companies should be valued at. I also don't know what kind of investments they have in them. But however, I think a market cap of 40 million is very low. And if one of these companies, I'd view it more like venture capital investing, where if one of these companies were to hit it big, you're probably going to make many, many multiples. But it's quite likely that most, if not all, of these companies will not succeed. So I think from my own point of view, I actually think the sector's really interesting. And as they highlight, they're the only way of getting exposure to it, unless you were to maybe take a longer term view and buy something like Cranswick in the hope that they would buy one of these businesses themselves when it becomes economically viable. But I think if you wanted some exposure to the industry because you thought it would do well, maybe allocating a couple of percent to this would be okay. But I think unless you know something I don't, or you can analyze it in a way that I can't, in which case someone can please feel free to get in touch. We'd be very happy to have you on for an interview because it is something I'd be interested in learning more about. But I think it would be very, very surface level of, oh, I think this industry could do quite well. These guys might have bought one of the companies that does well, so I'll just take a punt on it and put in 1 or 2%, if that. But I think to put any serious amount of money in, for me, I would just be totally uncomfortable with it because I don't have any ability to analyze it, I don't think. What about you, John?
Yeah, I would agree with you entirely on that. I don't think I have anything more to add. Yeah, I think unless you have knowledge of some of those industries and some of those companies, then I wouldn't be going near it.
Is it an industry you'd be interested in having exposure to, or would you be more likely to take a kind of longer term view and say, well, actually, I think something like Cranswick would
I
be better because they will probably end up going
Yeah, I
into
would
it?
probably do that. I'd feel much more comfortable doing that too.
Going back to what I said, I think if I were to, and I don't think I would, because I think one thing that for me is a bit of a turn off is the fact that it's been listed since 2014 and it's down 60, 70%. So, what have these companies been doing for 10 years? Because they've not been increasing shareholder value. If you were to invest in it, it's got to be an amount that you're comfortable going to zero.
Yeah, absolutely. Very good.
Shall we move back to
Yeah,
our retailers?
absolutely. So, not that this is dry, but it's Sainsbury's, so the third biggest of the supermarkets in the UK. They had a third quarter trading statement out, with the group reporting a 2.8% rise in third quarter like-for-like sales, excluding fuel. Growth was driven by a 4.1% increase in grocery sales as the group gained market share, enabling food volumes to grow faster than the sector average. And total general merchandise sales, including Argos, fell 1.5%, despite clothing sales rising by 2.2%. Full year guidance remains on track, with the group expecting underlying retail operating profit to grow around 7% to just over £1 billion. And retail free cash flows of at least 500 million are also expected. And the shares were down around 2% in early trading. In terms of valuation, Sainsbury's has a market cap of £5.8 billion and trades 11 times forward earnings with a prospective dividend yield of 5.4%. Again, similarly to Tesco's, I thought these results were pretty decent. Again, they were up against strong comparatives from the previous year, and they're certainly not shoot the lights out, but it's still impressive that they're gaining market share. You do wonder what's happening to Asda and Morrison's under private ownership, private equity, I should say. I think it's interesting, as we've talked about the income play. It's certainly quite a healthy dividend and chunkier than the Tesco's one at nearly 5.5%. I think growth again is the consideration here, and I think this would suit a certain type of investor. I think Sainsbury's, similarly to Tesco, is in a much healthier state than it has been over the last 10 years, but it's just what do you do for growth going forward? I suppose the answer is probably you look elsewhere, but for that, sitting in your portfolio and having a fairly steady, nearly 5.5% yield is not bad. Sam, anything more to add?
Think in terms of valuation, I think, although I think Tesco's a better business, I actually think Sainsbury's might be more attractive at this point, just because you are basically buying it for the yield, and the yield is just better. Although, like I say, I do think Tesco's a better business. I do find it interesting that M&S has outperformed by so much, and I think this is the first time I think we've seen this. So it will be interesting to see if in 6 months, if you get this again
Mm,
from M&S, or whether it was just a one-off, because there's no obvious reason in any of these three sets of results why M&S is so much
yeah.
better.
No, I take your point there. I would wonder whether people spend more at Christmas and splash out at M&S, and arguably compared with a couple of years ago, whether there's a little bit more disposable income and that people are choosing to spend it in M&S on fancier things rather than just sticking to your ordinary supermarkets like Tesco's and Sainsbury's. I don't know.
I think we'd need to see it in sort of another 6 months and see if it's more of a trend. Because like the problem is with just looking at one half in isolation. It's like if one of them just absolutely, I know it sounds silly, but if one of them absolutely nailed the Christmas advert this year that went on TV, that could be enough to swing it a percent or
Yeah.
two. Um, So yeah, I think I need to see a bit more, but I just find it interesting because there's no obvious reason why M&S should be so much better, and it's not. Although they have been performing very well in the last couple of years, this isn't. We're not used to seeing performance this good, I don't
Yeah,
think.
no, absolutely.
And I do think it's interesting as well because I know we can't see what Aldi and Lidl are doing, but
Mm,
three supermarkets essentially must have all increased market share, and
yeah,
like you say, it's got to be coming from somewhere.
yeah, no, absolutely, absolutely. Well, on to our US company then.
Yes, so Etsy, so these are old results, but because I own shares in Etsy and we haven't had time to cover it because there's always been a different US company, it's quite quiet this week, so I've gone back to Etsy. So these are the results for 30th of October 2024, which were the Q3 results. And the highlights for the quarter include consolidated gross merchandise sales was 2.9 billion, which was down 4.1% year over year and down 4.4% on a currency neutral basis. And consolidated gross merchandise sales includes a small headwind from the divestiture of LO7, which was kind of like it was meant to be like a Brazilian Etsy. They went out and bought quite a few similar businesses in the height of the pandemic, and by the looks of it, overpaid for every single one. But anyway, Etsy Marketplace gross merchandise sales was 2.5 billion, down 6% year over year and 6.3% on a currency neutral basis. And they've continued to see year over year gifting gross merchandise sales trends outpace site wide performance and represent a higher share of overall gross merchandise sales than the same period last year. Active buyers decreased 0.4% year over year to 91.2 million. They reactivated 6.4 million buyers, up 5.6% from the prior year period, and acquired 5.3 million new buyers. The retention of active buyers remains above pre-pandemic levels on a trailing 12-month basis, as does the quarterly new buyer additions. Gross merchandise sales per active buyer on a trailing 12-month basis for the Etsy marketplace declined 3.4% year over year to $123. The number of habitual buyers was down 4.8% year over year. US domestic gross merchandise sales represented 51% of overall sales. Consolidated revenue was 662.4 million, up 4.1% versus the third quarter of 2023, with a take rate of 22.7%. The positive revenue growth was driven by growth in both marketplace and services revenue, with payments revenue driving marketplace revenue performance, and Etsy Ads the primary driver of service revenue growth. Consolidated net income was 57.4 million, down 30.5 million year over year. And the consolidated net income margin was approximately 8.7%, with diluted net income per share of 45 cents. Etsy ended the third quarter with 1.2 billion in cash and cash equivalents and short-term, long-term investments. Under Etsy's stock repurchase program during the third quarter, they repurchased $156 million of common stock, and that is on a market cap of just under 6 billion. So these are quite substantial repurchases. And they've also, the Etsy board of directors have approved a new stock repurchase program authorizing the repurchase of up to an additional 1 billion of shares, which would be 1/6 of the market cap, actually. So that's pretty big. In terms of valuation, the business trades at a price to earnings of 27. However, we've covered this before. Etsy churns out cash, and the cash flow is usually a lot better. In terms of the price to free cash flow, it's actually trading at 8.6, which is incredibly cheap. I think these results are quite disappointing. We've had it for a couple of years now where it's just kind of slow decline in the business. Anecdotally, I find it odd because I think I absolutely love using Etsy. It's kind of for Christmas gifts and stuff like that. I always will buy at least one or two things on Etsy, and I know there's like Chinese businesses and stuff like that, but I don't think they're really comparable. I think Etsy's actually got quite a unique position in the same way that probably eBay does. I think it's quite a unique website, and I just think it'd be incredibly difficult for someone to come and knock it off its perch for kind of unique gifts and like artisan products and stuff like that. So I really, really like the business, and I think that does cloud my judgment with it sometimes. But I just I find the valuation so odd because even though these results are, this slow decline is disappointing to see as a shareholder, it's so cheap that you don't really need to worry about it because it's almost if you were to go through some of these numbers, over a couple of years, quarter of quarter, and sort of take out anything that's unique to Etsy, so like references to habitual buyers and stuff like that, and then how the business is doing, you'd think they were selling cigarettes because
Mm.
it's incredibly similar actually. The repurchases are absolutely huge. What disappoints me probably the most with Etsy is that it reminds me a bit of Fiverr, where I think they're relying a bit too much on take rate increases rather than just
Mm.
improving the underlying business. But a price to free cash flow of 8.6, you're probably getting a stock repurchase yield of like close to 10%. And it's only well, actually, the revenue's still going up, so it is like a carbon copy of some of the tobacco results that we see. I'd like to see the business performing better, and I think the business can perform better, unlike a tobacco
Mm.
company. And so I think there is still that potential there. But even if not, it's just so cheap that I just find it baffling, actually, the valuation. So I'm very likely to top up on this at some point. What do you think, John, as someone with a bit less bias?
I think it's difficult. I did like the business, but I think it has been underperforming in the last couple of years. And my worry after holding another business that we thought was very cheap, which was Boohoo, is that with some of those Chinese competitors, are they essentially coming in and eroding the investment case for Etsy in a way that Etsy, can't compete with? And is that why things are declining? And probably the valuation reflecting that. I think that is my main concern and probably why I wouldn't invest. But I think on the surface, it looks like a good quality business, albeit having a difficult time. But I think that's my concern with it and why I wouldn't invest.
If you were a small business making some kind of handcrafted product, where would you go?
Yeah, I take
And
your
I
point.
think in terms of the people that are going to go to the Chinese websites, they're not going to expect the same quality of product. I think it's quite, they might be able to capture some of like the cheap tack and stuff that's on there, but in terms of the actual hand, what Etsy is
Mm,
intended for, I just don't see that going over, moving over. And I think where Boohoo's different is Boohoo, what was driving their business was they were competing on price. They were the
mm,
lowest cost operator. So if someone comes in with a lower cost than you, you're dead. And that's what happened to Boohoo. Etsy doesn't really have that issue. I think as long as the artists are still staying on there, and we went through these figures, and yes, it's disappointing with the gradual declines, but those declines weren't in the number of sellers. It was kind of the
yeah.
buyers and stuff. So yes, some of the demand might have gone for some of the, but is that core kind of what you would associate as an Etsy product still on there? So if you want kind of a quality homemade product, that is the only place to go.
Yeah, no, I mean, I take your point. I think that's it's having been burnt with Boohoo that sort of makes me a little bit more reluctant with a business like Etsy.
So in that case, of the six businesses we've covered this week, M&S, Greggs, Tesco, Agronomics, Sainsbury's, and Etsy, which do you like the most and which do you like the least?
Oh, I would probably say it's between Tesco and Sainsbury's for me. I might towards Tesco, sorry, towards Sainsbury's. Just it's a little bit cheaper than Tesco's. It's got a slightly higher yield. I think Tesco's is probably the better business, but on valuation, I'd go for Sainsbury's. In terms of the business I like the least, it would be Agronomics.
So I think for me, it would just be Etsy based on valuation. I think I do have a bit of bias because I do like the product so much. If I exclude that, I think I'd be tempted by M&S actually. In that I think they've
Okay.
got more opportunity to increase market share than say a Tesco do. The dividend's quite low, but I think that's because they're still in the process of a turnaround. So in 5 years' time, I'd expect that to be a much higher percentage yield. I think in terms of the business that I like the least, it'd probably also be agronomics. I think it's an industry that I wouldn't mind having some exposure to because it does just seem quite obvious that at some point, if you can grow meat cheaper than you can get it from a farm, it's and that meat is genetically identical. Commercially, it's a bit of a no-brainer. But how many years it takes to get there, I don't know. And whether any of those 20 companies do end up being the winners, because you can look at the share price in terms of, they bought these companies 10 years ago. And it's like, well, actually, did they buy some of them 10 years too early? So I think I struggle with it. And if Cranswick were to go and just buy one and say, well, we're going to invest, we're going to put our resources behind making this work, and we're going to be selling it alongside our other products, I'd feel much more comfortable with a
Fair enough.
Cranswick.
Well, thank you very much for listening, and we'll see you again next week.
See you next week.
Thank you for listening to The Investor Way. To get in touch, please follow us on Twitter at TIWTweets. This podcast is for entertainment purposes only and does not constitute financial advice. Neither Sam nor Jonathan are financial advisors. For investment advice, please consult professional advisors.